Welcome to the All Financial Hour podcast with Steve All.
Steve, how are you doing? What's new in your world?
Person came in earlier this week. She'd been retired for about 5 months right now. And I said, how you doing? She goes, I've been busy. I said, yeah, that's probably a true statement. I'd say within about 4 or 5 months, you're going to come into the office. You're going to say, I don't know when I had time to work. I'm so busy now. And you know how many times I hear that when people come in and
I believe
started that retirement journey. And that's what I love about this job is most of the people have retired once. Some have went back to work and retired again. But most people retire once. And we get to help walk them through that retirement. And I think that's the most fun that we can have as financial advisors in this business is helping people in their retirement because they got so many questions. Where am I going to get my money from? Mm-hmm. You know, where should I take this from? Where should I do that? How much am I taking too much risk, too little risk? And I think that's the greatest thing that we get to do on a daily basis. Sit in an office and talk to people I enjoy talking with about retirement and helping them get what they want out of their retirement funds.
That's what it's all about, getting what you want out of your retirement. I love how you say you guide them, and that's the perfect way to say that because you're guiding them on this road to retirement. Lots of questions, things come up. Everybody's situation is different. And if anything we're talking about right now kind of resonates with you and you think, yeah, I've been looking for somebody to help me, guide me, help me get to that finish line. I can see it, I can feel it, but I don't know how to get there and do it successfully. This is where Steve and the team come in. And I'll tell you what, this is as easy as doing a comprehensive retirement plan, something that we offer, I think, every single week, Steve, right?
Yeah, every single week, the comprehensive retirement plan holds what I call the pillars of retirement. Income. As Mel always puts it, there's only one thing important in retirement. 3 most important things. Income, income, and income. Then we're going to look at your risk reward. How much risk are you taking for the return that you're getting? Is it in line with each other? Then we're going to look at taxes. We're going to look at fees, not only what I would charge, what you're currently being charged. And then we look at that legacy type planning. How are you going to pass these assets on to your kids? We believe that's very, very important. And we will talk to you about long-term care. It's one of those things that usually gets forgotten, but it's one of the main reasons why I'm in the industry because nobody talked to my parents around it. And then my parents, when I finally moved from dealing with corporate clients to individuals like my parents was, what are you going to do if you have a long-term care exposure? Mm-hmm. What are you going to do? Everybody's got a long-term care plan. And I know somebody just said, I don't have a long-term care plan. I said, yeah, you do. Open up your portfolio and circle the asset you would circle first if you or your spouse had to go into a facility. That was my parents' plan. And I didn't like that plan. So I talked to clients about it. And a lot that becomes the plan. But it was a decision they made, not just a lack of options.
Now, the Federal Reserve first interest rate cut in 4 years, it was kind of an aggressive one. Instead of just a 1/4 of a point, they put their big boy pants on. They went with the big old half-point reduction. Here's J.P. Morgan's David Kelly on CNBC.
Cutting interest rates at the start doesn't stimulate the economy at all. It actually slows the economy because people begin to anticipate those lower rates, so they want to wait for lower rates. It tells people that the Fed is scared about unemployment. I don't think they really should be, but that's the message it gives, so it undermines confidence. Bringing rates down from a high level is like bringing a piano down as a flight of stairs. You've got to do it very carefully and very slowly. That would be the right way to do it. And I'm a little worried they've started off in a rush here, but I do think this economy is strong enough to deal with percent. So I think it's still a healthy, strong economy.
All right. Well, there's plenty of uncertainty ahead of the Fed's expected cut rates through next year. Steve, what are you telling clients who are calling up concerned about this?
Well, the big thing about interest rate changes is when they're going down, certain parts of the economy are assisted by that, and certain parts of the economy are hurt by that. Seniors were helped when we had higher interest rates. Why? Because our CDs were paying more. We could actually get something out of a money market account. So for them, it's coming down a little bit. Who has it helped? It's helped the younger generation. It's people that are buying homes, people that are buying cars. If they can get those interest rate down, that does stimulate the economy. But we had a potential client come in, Debbie and Sally. They said they had moved $100,000 into CDs. What should they do in the future? I said, the only thing you want to do is if you're like them and you've bought CDs over the last 12 months, be careful because the automatic renewal is a very short window. And as interest rates drop, those CD rates will drop also. And you could lock yourself into a 1-year CD that you might not want. So please be careful when you're looking at CDs and money markets on where those rates are at, because they are going to come down. The other thing that I think it was in the advantage to was the annuity world. If you've got an annuity that's more than 2 to 3 years old, the new annuities with the higher interest rates, they have higher caps, higher earnings potential, and participation rates. And if you've got an income-paying annuity, one that's got the availability to turn on an income rider and you have not turned it on yet, give us a call. Let's look at that annuity x-ray. And what that annuity x-ray does is we'll look at that contract and see, with the higher rates if they got right now, they're going to be going down soon, but they're higher right now, and it might make sense to move an older annuity to a new annuity. Now, if that happens, you might have a slightly longer surrender charge depending on when you bought it. So there are some pluses and minuses. So if you're in that category, annuity, 2 to 3 years old, if it's got an income rider and you haven't turned it on, give us a call. Ask for that annuity x-ray to see if we can still take advantage of the currently high interest rates.
And the best part is that it's complimentary, 636-230-8824. Again, this is for this complimentary annuity x-ray, 636-230-8824. The website, as always, yourmoneymattersstl.com. Now, Steve, for those that are interested in coming in and meeting with you, let's explain what that first appointment's like.
It's more about finding out what your wishes, hopes, and dreams are and what retirement means for you. We'll send you a data collection. We're going to ask you to bring in information. We'll ask you to bring in copies of your statements. If you haven't taken Social Security yet, we're going to need copies of those. I like to look at your tax returns because it's hard to talk about taxes if I don't know where your returns are at. That meeting takes about 45 minutes to an hour and 10 minutes, depending on the questions that you have. And then we schedule you to bring you back in a couple weeks later to go over that summary of plan. Give us a call now. Ask for that comprehensive retirement plan.
Healthcare costs can literally evaporate your retirement savings without proper planning. And that's why it's important to carefully manage Medicare benefits. And a big part is the program's open enrollment period that's coming up in just about 2 weeks here, October 15th through December 7th. What are some of the things that retirees should know ahead of time, Steve? And what can you help them with as far as navigating this whole Medicare maze?
Now, I don't do Medicare myself. I do ship all that out, Scott Stream. But some of the things around Medicare, because people get confused because there's open enrollment, there's initial enrollment, and general enrollment. What do they all mean that different? What they're talking about with the open enrollment period is somebody that's already on Medicare, and now you're figuring out your Advantage plan or your supplemental plan. Can you change it? That's what they mean by open enrollment. So you can switch back and forth between that plans. And what I like to basically say for people is it's not like normal health insurance. Just set it and forget it. If your health situation has changed, go back to the person that you got the Medicare, either Advantage or supplemental plan through, and find out, is this still the best plan for you? I think that's very important to do. Most people set it and forget it. But if your medications change or the new medications are covered. Some people, the Medicare Advantage plan, if you're not using it, your health is great and you're not using hardly anything, the Advantage plan could be more beneficial for you at this time. The premiums are almost nothing, and you might get some extra things with it. But you have to be careful if you start to get sick. You want to make sure you get back to the other plans because they do cover a little bit more. That's what we call open enrollment. Initial enrollments, you're going to turn 65. You get the month that you turn 65 to apply for Medicare. You get the 3 months before it and the 3 months after it. That's what we call initial enrollment. What if I didn't get any Medicare? Is open enrollment for me? No. You have to wait until January for the general enrollment. So there are 3 different dates on that. If you got any questions about which one you should do, give us a call here at the deal. We'll give you a call back to figure out which one you're currently under. But that's the reason why I don't do Medicare in my office. I give all of my Medicare appointments to Scott Stream. He's great with it. He's great with my clients. I don't want to do all the continuing education that he has to do to keep up with all the plans and how they're going to change.
Did you hear about this rare dime that's expected to fetch $500,000? Exactly. A dime, supposedly worth $500,000. It's one of two coins missing a mint mark, which is like the letter S for the San Francisco Mint there. If it gets the expected $500,000 at auction, that will make it a 5 million % return. So let's get back down to earth here. That is insane. What's a more realistic rate of return for our retirement savers?
That's one of the things that I think we can go to a lot of different directions for. Sally came into the office, and I always ask the question. We have the big 10-question questionnaire to figure out risk reward, but I always ask a very simple one. If you could pick between 1 and 10, 1, I am as conservative as you can possibly be, and 10, I am as aggressive as you can possibly be in the investment world. Which would you be? Sally said 4. Then I look a little bit further into her initial information, and it says expected rate of return, 20%. And so I stopped, and I said, Sally, I said, I want to go ahead and address this now. I usually don't address risk reward until we get to that second appointment, but we've got a wide variation here when we start to look at this. You know, the S&P 500 has averaged about 10%. Well, you're wanting to take 40% of the risk of an equity market, but you want twice the returns. Let's look and see how we can get these things more in line. And I think that comes about quite a bit. There are a lot of people out there that are expecting these 12, 13, and 14% returns that we had back in the 80s and the 90s. And I say they could happen, but it's a tough expectation. And why would I say that? One, the 401k didn't even come around until the 80s. So we had a lot of buyers in the market, not a lot of sellers.
Yeah.
Because individuals had to buy individual stocks prior to that. Now we've got mutual funds, and it's going into 401ks and smaller lots, so there's plenty of buyers. Well, what happens in the market when you have more buyers than sellers? The markets go up. So I think we had those higher returns of the 80s and the 90s because so much money was getting plowed into the market. Now let's fast forward to 2024, and the baby boomers are all retiring at 10 to 15,000 a day. Now we have people that are required minimum distribution age. We got forced sellers in the market. And the younger generation is not buying into the market the way we did. So now we have more sellers than buyers. So I look at it for a realistic expectation for returns. I believe stocks over time, they're going to have good years and they're going to have bad years. But over time, I think they're going to average in that 6 to 8% category. I think bonds are going to average in that 4 to 6 category. I don't think those days are very important. But I look at it when I start building portfolios for people. I want the best investment that I could get with the least amount of risk possible. I think that's what we're really looking for. And that's what I've loved about Market Guard. I can adjust people's portfolios. If you're ultra conservative, I've got a portfolio for you. If you're ultra aggressive, I've got a portfolio from you. Most people are a combination of those things, and I think it's absolutely wonderful that I can be aggressive, that I can be defensive. So if you're not sure of what your returns are and what you're currently getting and how much risk you're currently taking, call now, ask about that risk-reward analysis, give us the availability, sit down with you, and look at the risk that you're taking and what kind of reward you're currently getting for it.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group LLC.
This radio show is intended for information purposes only.